Well, hello everyone, and welcome to your Daily Five. I'm Joe Duarte from Duarte and themoneyoptions.com, author of the best-selling book, Options Trading for Dummies and Investing in Your 20s and 30s. If you like what you see today, please consider a free trial to my website. Let's get started. We have a lot to talk about. Today, we're going to be preparing for a liquidity crisis and how to adjust portfolio risk. Our goal is to assess the future of stock prices based on liquidity analysis and using it to adjust portfolio risk. So we need to understand what liquidity is, how to measure liquidity in real time, and how to adjust that portfolio risk accordingly. The first thing we want to do is define liquidity. And of course, that's the amount of money available to buy stocks after investors cover their bills. And I like to think of it as the lifeblood of the markets. I will continue to pound that message in, the lifeblood of the markets. So where does liquidity come from? Well, at its most basic, it comes from the Federal Reserve. When the Fed buys bonds from banks, it increases bank reserves, increases liquidity in the system. It's otherwise known as easing of monetary policy. The opposite is true. When the Fed sells bonds to banks, decreasing liquidity, and that is called tightening of monetary. That is called tightening of monetary policy. So the key point here is that monetary policy is the key to liquidity. So why is liquidity important? Because liquidity is the lifeblood of the financial markets. Without liquidity, markets crash and you get into a situation called a liquidity crisis. And you need to think about things like the Lehman Brothers crisis, the 2008 mortgage crisis, and the 2020 COVID bear market in order to understand what happens during a liquidity crisis. So in order to understand liquidity, we must understand the Eurodollar system, which is how you gauge systems liquidity. Remember, Eurodollars are not related to the euro currency. These are dollar-denominated deposits in any foreign bank, not in the United States, not regulated by the Federal Reserve. I like to think of it as a big slush fund, because corporations can have easy access to this money and close transactions quickly. It's also a hedging mechanism. It's a source of emergency funds for big deals. And it's basically a short-term CD, which is used to square the books by banks on a regular basis. It's usually defined as a futures contract based on these deposits. And I like to use a composite called the Eurodollar index, which I will get into it in a little bit here. But the key here is that it's also a predictor of the market's expectations for the future of interest rates. And because it's so sensitive to what the Fed does, it's a great way to predict liquidity and to get an idea as to what the current liquidity in the market is. So the practical applications of the Eurodollar index is that Eurodollars indirectly measure the status of the market's liquidity. When the XED, which I will describe in a second, rises, it means there's rising liquidity. When the XED falls, it's falling liquidity. High liquidity usually leads to higher stock prices. Low liquidity leads to lower stock prices. And the Eurodollar market is the most sensitive instrument to any action that threatens liquidity. So let's look at that XED symbol and see what happens. This goes back to February, March of 2022. You can see that the Fed was raising interest rates and the XED was falling, which means that liquidity in the system was being drained. We also see that sometime late in 2022, the XED began to move sideways, which stabilized the system. And as you'll see later, we had a stock rally based on that. But lately, in the month of February, XED has essentially collapsed and liquidity has tightened. That's why the market is so volatile. So here's a quick formula that will help you understand this better. If you take 100 minus the Eurodollar price, that tells you what the implied short-term interest rate is. So we look back here when the XED was trading at 98, 100 minus 98 interest rates in May of 22 were essentially 2%, and interest rates now 100 minus 94.75. Basically, the market is betting on 5.25. Low liquidity. So what is the direct effect of liquidity on stock prices? Well, first, let's focus on XED. And we can see that XED has fallen, as we showed earlier. We can see that as it was falling, there was a great deal of volatility in the New York Stock Exchange advanced decline line. We see a small period of stability here in summer 2022. We saw that summer rally, but as soon as the XCD began its resumed its downward course, we had a crash in the market. And again, same thing here. XCD gets very nicely stable and stocks rally. Also note that when XCD falls, because the liquidity is scarce, the CBOE volatility index, which is a gauge of bullishness and bearishness, rises. And that means that low liquidity leads to bearish sentiment and stocks falling. Let's look at this in terms of the S&P 500. Very similar picture. Again, XCD falling, stock market falling. Again, XCD gets stable, S&P 500 rises. Once the XCD fall resumes, S&P 500 again falls. And of course, we look at the stability period here in XCD and how we had a rally. But guess what? In February of 2023, as the market started getting more bearish and XCD began to fall again, stocks are again in a big funk. Just a quick look here. That big volume by price bar tells us that this area right here around 4,039.50 is crucial. This is actually a market call here. If the market breaks below this area, I would expect significantly lower prices. And you can blame it all on this low liquidity from the Federal Reserve squeezing the market. So Federal Reserve changes interest rates, Eurodollars respond. Again, rising XCD, rising liquidity, falling XCD, falling liquidity, high liquidity, higher stock prices, low liquidity, lower stock prices. So bottom line, Eurodollars is a great way to measure the market liquidity. It's quick. It responds rapidly to what the Federal Reserve is doing and the market's liquidity. And of course, it's connected to VIX, New York Stock Exchange advanced decline line. So when sentiment and liquidity line up, prices follow. So how do we adjust our portfolio risk? The traditional conditions for bullish trends are obvious. When the Fed eases, you have ample market liquidity. And of course, when liquidity falls, you have falling stock prices. So let's adjust our portfolio risk. We first review all our positions and we focus on relative strength. If it's working, you hold on to it. If it's not working, you can either reduce your position size or exit the position altogether. And certainly you can consider hedging your open long positions. And of course, your hedging alternatives are you can sell call options or remaining longs. You can buy put options. You can buy inverse ETFs, or you can do all three of them. Today, I want to focus on inverse ETFs, and I like to use the ProShares Ultra Short S&P 500 ETF. Remember, this is leveraged, which means it moves up or down at twice the rate of the S&P 500. You can see that when the stock market was falling in early 22, SDS was rising nicely. When the market rallied in August of 2022, SDS fell, and it has an excellent correlation to the XCD, generally a downtrend when XCD is stable, but when XCD is falling, it generally tends to rise. Currently, if we remember the chart of the S&P 500, I looked at a couple of slides back, you can see that SDS is correctly testing key resistance level. That means it's somewhere around 44, 45. If SDS breaks above that, that'll probably be because the S&P 500 has broken down. So to recap, liquidity is the #1 factor in determining stock prices. Interest rates and the Fed start the cycle. The action in the Eurodollar market confirms that it does so very quickly because it's very sensitive. Then you look at your market breadth and your action in your indices. And remember, tight liquidity is time to manage risk. Well, that's all I have for today. I'm Joe Duarte from Joe Duarte and themoneyoptions.com, author of the #1 bestseller in options trading for dummies. If you like what you saw today, please consider a free trial to my website. And remember, Trading is uncertain. Always be prepared.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.